The theory is that we can use that public company data and apply it to our company A in this case. All right. So typically what we'll do is we'll identify these companies, and we'll talk about where we find these companies in a moment. We'll identify them, we'll analyze their financials, we'll figure out what is their total enterprise value, and then we'll relate that to what is their revenues, what are their EBITDA, what is their EBIT, that type of thing. We'll calculate valuation multiples, and then we'll selectively apply those multiples to our company A in this case, our subject company. All right, so that's where we're going with the exercise. We're going to talk a lot about how to calculate those multiples. That's really kind of the high-level reason behind what we're doing here. Does that make sense? Now, in terms of finding public companies, if they're out there, it's pretty easy to find them. All right. A lot of times, you can find out information from talking to the management team. All right. So if company A has engaged us as investment bankers, we can ask them, well, who are your comparables? Who are your closest competitors? All right. And that could give us some clues. Okay. We can look at equity research reports covering the food industry in this case. Probably find all the top companies in the food industry. We can look at competitors sections from a 10K. All right, so if our company A tells us, well, we're most similar to Heinz, we can go to the 10K of Heinz, look at the competition section, and it may identify some other companies that we would compete with in the industry as well. Does that make sense? All right, so those 10Ks can be a really good source of information. We can also use something called SIC codes. Who knows what an SIC is? It's a standard, SIC stands for Standard Industry Classification, and it's a 4-digit unique numerical code that gets assigned to companies in each unique industry. All right, so if you find a company that has SIC 4283, you can do an SIC code database search on 4283, find other companies engaged in that same line of business. You can also use something called NAICS codes, North American Industry Classification System. Same idea, except they're 6-digit codes. All right, so if you know an SIC, if you know an NAICS code, you can quickly search the internet, figure out what companies have those same codes. And theoretically, at least, they're in the same industry. We should consider them as potential comps for a comparable public companies analysis. All right, we can also search the internet. We can Google food companies. We can probably Google a lot of different search terms and find companies that might be comparable. And especially, if we're working in an industry group of an investment bank, let's say we work in the food group of Goldman Sachs, if there is such a thing, we can talk to senior bankers in that group. They're going to know all the companies that are engaged in that line of business. They'll probably be able to tell us real quickly who the right comps should be. All right, so the goal of this exercise, find companies that are similar along those lines, figure out what their valuations are, figure out what their valuation multiples are, and then we'll selectively apply those multiples to our company. All right, that's basically what a comparable public companies analysis, what it is. And anytime we're talking about a multiples-based analysis, we're talking about what we call a relative form of valuation. All right. So a relative valuation multiple involves, a relative valuation methodology involves multiples. Comparable public companies is a relative valuation methodology, so is precedent transactions. But a valuation multiple is basically a ratio where you've got some value in the numerator, and in the denominator, you've got some operating metric. Okay, most of us have probably heard of a PE multiple, a price earnings multiple. All right, so in a price earnings multiple, that denominator or that numerator is share price, which is indicative of market value of equity. Denominator is net income or earnings. All right. And if we know that companies in a certain industry trade on average at 25.5 times, company we're trying to value has earnings of 30 million, we can do some quick math. 25.5 times 30 gives us market value of equity in this case of, I believe, 765 million. All right? That's how a multiple gets applied. Does that make sense? Now, there are two types of different multiples, and I've touched on these before. A price earnings multiple is something we would call an equity multiple. All right? The reason we're calling that an equity multiple is both the numerator and the denominator are specific to the equity holders of the company. All right, remember, share price, that numerator, is the price of equity. And the denominator, earnings, comes after debt has been paid. All right, so those are earnings that are available to the shareholders or the equity holders of the company. So you've got equity multiples. These are also called what? Levered or unlevered multiples. These would be known as levered valuation multiples because they depend on how much debt the company has. All right? More debt a company has, the more interest it has. The more interest it has, the less earnings are going to be available to the common shareholder. Make sense? So levered or equity multiples would include PE, okay, operating or unlevered multiples would include any multiple that has total enterprise value in its numerator. And remember, when we have total enterprise value in the numerator as a value of the operations, the denominator needs to be specific to the operations as well. Basically anything EBIT or above in the income statement. Remember when we did that yesterday? That's why. This is where we're tying that back. So we would divide total enterprise value divided by revenues, TEV divided by EBIT, TEV divided by EBITDA. These are all operating multiples. We can also call them unlevered because we're looking at total enterprise value that does not depend. Remember, it does not depend on how much debt the company has. We're blind in terms of how the company's financed itself. All right, so I've got a little Excel worksheet that I've created. I can send this out to you. I probably will send this out to you tonight or tomorrow, along with the summary email I usually like to send after class too. This is going to demonstrate the effective leverage on price earnings multiples. All right, so here's kind of an example to tie together what we've been talking about so far. We have two companies, creatively named Company A and Company B, that are identical down to the EBIT line. That is, from an operating standpoint, we've got the same revenues, same cost of goods sold, same gross profit, same SG&A, same EBIT. They also have the same amount of D&A, depreciation and amortization, so they would have the same EBITDA as well. 20 plus 5 would be 25 million in EBITDA. All right. And remember what we talked about in terms of enterprise value, these companies, how should they be valued? They're identical from an operations standpoint. So finance theory would tell us that they should be valued how? Should be valued identically. They should have the same enterprise value. Okay? And they do. They actually have enterprise value of 100 each, which equates to these multiples. So if we take total enterprise value of 100, divide it by revenues, gives us a 1 times multiple in both cases. Total enterprise value of 100 divided by EBITDA. Remember, EBITDA is 25, so we get a 4x multiple. Total enterprise value divided by EBIT is 5 times. Okay? Just as finance theory would tell us. They're the same from an operating standpoint. It doesn't matter how they're financed. They should be the same at the enterprise value level. But now when we consider capital structure, that is, how much debt and how much equity these companies have in their capital structure, the relative proportions of each, we see that these companies are very, very different. In fact, they're polar opposites in terms of their capital structure. Company A, of that 100 million in equity value, 90 million of it is debt, 10 million is equity. Company B is the exact opposite. They've got only 10 million of debt, the balance 90 million is equity. Does everybody see that? All right, we're going to assume in this example their interest rates are the same, they pay the same interest rate on their debt, and they've got the same tax rate. Right, purely hypothetical situation, but what we want to do now is show the effect of that leverage on the remainder of their income statement and then translate that into how their price earnings multiples will differ purely as a result of leverage. All right? So in the case of Company A, they have EBIT of 20 million. Their interest would be multiply their debt, or 90 million, times 10%. So they pay 9 million in interest, which would give them pre-tax earnings of 11 million. They pay taxes at the 40% rate, 4.4 million in tax, leaves 6.6 million in net income. Everybody follow that? Company B, again, exact opposite in terms of capital structure. When we calculate their interest, we multiply their 10 million in debt times 10%, gives us 1 million in interest. Pre-tax earnings of 19 million, pay taxes of 7.6, and they end up with net income of 11.4 million. All right. So these companies that were identical from an operating standpoint, because of their capital structure, look really different at the bottom line. And now we can translate that into a price-earnings multiple. If I calculate their price-earnings multiples, for Company A, it would be their market value of equity, 10 million, divided by their net income of 6.6, gives me a multiple of 1.5x. And when I do the same for Company B, we see a radically different price-earnings multiple, 7.9 times in this case. And this difference, again, purely due to how these companies finance themselves. But at the enterprise level, at the total house value level, they're the same. All right, so again, operating multiples would include anything that has total enterprise value in the numerator, and then any operating metric in the denominator above that EBIT line. All right, equity multiples, we're talking specific to the equity in the numerator, so the price of the stock divided by earnings. Earnings are after debt, they're after interest, purely related to what's available to the common stockholder. Okay, so in a case, if we take a look at some operating multiples, we've got a company, again, going back to that example earlier, 11.5 billion in enterprise value. Let's add some more data to this. Now we assume they've got roughly 4 billion of revenues, 1.4 billion of EBITDA, would give us a revenue multiple of 0.59 times, and an EBITDA multiple of 8.4 times. Right. In each case, all I did was take enterprise value divided by revenue, enterprise value divided by EBITDA. All right, and again, why is total enterprise value a part of operating multiples, not market value of equity? We really just touched on this. Again, first of all, we need to be apples to apples. All right, so we've got an unlevered metric in our numerator. We need to have an unlevered metric in our denominator. And probably most importantly, total enterprise value ignores capital structure, ignores leverage. Okay, those line items before interest are debt-free or purely related to the operations. Market value of equity is specific to the stockholders. Okay, so if we've got another example here, kind of using some of the same numbers. If we know that this company A has 19.4 billion of revenues, 1.4 billion of EBITDA, and we know that the average trading multiples for companies in this industry, 0.74x revenues, 10.3x EBITDA, we can do some math. Calculate enterprise value using the revenue multiple, enterprise value using an EBITDA multiple, and in this case we average the two to come up to a value of 14.2 billion. Okay, and now equity multiples again. Anytime we're talking about equity multiples, if we apply an equity multiple to a company's earnings, it's going to give us an indication of market value of equity. We can still calculate total enterprise value using our formula. Okay, so we can use a PE multiple to get to market value of equity. Then we can add debt, we can add preferred, we can add minority interest, we can subtract cash. But on its own, equity multiples will give us market value of equity. All right. So this is why you frequently hear analysts speaking in terms of PE ratios, because most people own stock. Most people are not owning debt. They're not owning, aggregate companies. All right. So most people are concerned with stock prices. So PE ratios are applicable in that case. But again, in banking, we're typically trying to calculate the whole value of the firm or the value of the house, as we talked about before. Okay. And again, we always want to be apples to apples. We would not want to, for example, say total enterprise value divided by earnings. Total enterprise value is unlevered, earnings are levered. They're after debt. They're dependent upon leverage. Same thing, doing price to sales or price to EBITDA would not make sense because price is related to shareholders, EBIT or EBITDA or sales are unlevered. They're available to all providers of capital. These will get asked. If you get into a banking interview, you'll get asked these questions. They'll try and trip you up. They'll say, oh, well, what is the total enterprise value to sales multiple? Or what is the price to sales multiple? Right, and the correct answer is you wouldn't want to calculate a price to sales multiple. It's apples to oranges. You'd either want to be unlevered to unlevered or levered to levered. All right, so you will get these questions. You'll get all different variations on these types of things if you get into banking interviews. All right. Now that we've talked about multiples, let's talk a little more about spreading comps. Okay, we did a basic spreading exercise last night. We spread the income statement and the balance sheet of Heinz. When we talk about spreading a comparable company, it's usually a much more in-depth exercise. We're going to do an example of this in a moment, and then you're going to get to do some for homework as well. But basically, getting all the data from all of our comps into a valuation template such that we're able to calculate valuation multiples for each of our comps. So if you think of all the data that are required to calculate a PE multiple, total enterprise value to revenues, EBIT, EBITDA multiples, we need to capture those in one place. We need to capture things like non-recurring charges, like we talked about before yesterday, in order to get to accurate measures of revenues, EBIT, EBITDA, earnings, etc. Okay, we also need to capture how many shares the company has outstanding, what's its stock price, calculate the effect of dilution. That is, what about employee stock options that could get exercised? Maybe the company might have warrants. Maybe it might have convertible securities. So when we talk about spreading a comp, we're trying to capture all of these data in our model. All right, we're typically doing this on an LTM basis. That's why we did that latest 12 months example last night in the homework. All right, we're always calculating things on an LTM basis. We're always normalizing the numbers. So for each comp, we need to read the MD&A section, really look at the notes, make sure we understand what non-recurring items might be in there. Did the company have damage from a hurricane last year? Did they win a lawsuit? Did they have a big layoff and have a lot of severance expenses that they wouldn't expect to have year after year in the future? Did they have continued versus discontinued operations? Remember we talked about that yesterday. If they did, those will be broken out in the income statement. Okay, and also as part of this spreading exercise, we'll capture forward-looking numbers or earnings forecasts, revenue forecasts as well. Okay, and typically we get these from analyst reports. So public companies oftentimes have research analysts that follow them. They talk about what's going on in the business. They make estimates of what they think the company will do over the next few years. We'll pull some of these data out of some research reports and include those in our spread exercise as well. All right, so spreading a comp very much, it goes well beyond what we did last night for homework. A much more detailed exercise. Can be time consuming, all right, but with practice people get pretty good at doing this. Right? Anybody ever perform a valuation and do a comparable company's spread before? Yeah, okay. Well, you took the class earlier, so that doesn't count.
Just basic financial statement analysis, right?
It's that. There is a lot more to it as well. All right, so we're going to go through that. Again, at the end of the day, it's geared toward being able to calculate these multiples. All right, and then we'll take the exercise and we'll apply these multiples to the company we're trying to value, our subject, our company A in this case. All right, but spreading the comps is the first step in the process. When we're calculating total enterprise value, again, everything needs to be on a fair market value basis. All right, so we're taking the market value of equity using current share prices. We assume that the market is pretty efficient. We assume that that share price is representative of a fair market value. Okay, we multiply that by shares outstanding. And I mentioned it earlier, on a fully diluted basis. So we're going to talk about that in a lot more detail and how to figure out and measure the effect of dilution. Take the fair market value of any preferred stock, if they have it. Not all companies do. But if they do have it, they'll usually have either a public market price, if it's publicly traded, or they'll have something called a liquidation preference. That is the amount at which the company would need to buy that back at some point in the future. All right? So either it's public and you can look up the price, or if it's not publicly traded, there'll be some indication of the liquidation preference in the notes to the financial statements. It'll tell you the information you need. Fair market value of debt, typically we take that right off the balance sheet. Right? Unless the company is distressed and we think they're not going to be able to pay their lenders back in full, we assume that what's on the balance sheet is indicative of fair market value of minority interest, fair market value of cash. We pull those right off the balance sheet as well. All right? So a lot of these items really come straight off the balance sheet, which makes our job easier in some respects. Right? But there is still a lot of information we need to take into account and a lot of work that we need to do to get there. Well, let's talk about the concept of dilution. This is probably one of the more time-consuming exercises in our spreading exercise, or at least maybe one of the more difficult portions of this exercise to understand up front. Right, what do we mean when we say dilution? Who can tell me that? What gets diluted? Well, the stock price can be affected by dilution. Typically when we're talking about dilution, we're talking about the formula for earnings per share, which is calculated net income divided by shares outstanding. All right. When we say dilution, we're talking about anything that would cause this ratio to fall. All right. In the case of calculating our shares outstanding, anything that would cause that share count to rise, keeping net income constant, would result in a situation where there's less net income available for each individual share outstanding. And typically what we're talking about when we mention dilutive securities, we're talking about things like stock options, warrants, maybe convertible securities, preferred stock or debt that can be converted into shares and drive up that share count. All right, so that's what we're talking about when we say dilution, something that would dilute earnings per share. All right. Now, when we look at these types of convertible securities or dilutive securities, we need to look and consider whether they are quote unquote in the money or out of the money. What do I mean when I say in the money? In the money means it would make sense, would make economic sense for the holder of that security. Let's say it's a stock option to exercise that option. All right, that is, the option becomes more valuable to the holder once it's converted. Same thing for convertible securities. If I have preferred stock, if that convertible preferred stock, if it's in the money, it means that when I exercise it, when I convert it to common stock, it becomes worth more to me as common stock than it was as preferred. Okay, we're going to do a bunch of different examples on that.